The best investor in the world isn't watching CNBC right now. They're not at a Bloomberg terminal. They don't have a finance degree. They're not running some complicated option strategy in a spreadsheet. There's actually a decent chance they're dead. Stick with me. Fidelity, one of the biggest investment brokers in the world, apparently looked at which of their customers had the best returns. You'd expect the winners to be experienced traders, longtime investors, people who really know what they're doing. What they found was surprising. The most profitable portfolios belonged to people who forgot they had an account, or people who had died. Whether or not the exact story is perfectly documented, the idea points to something very real. The real winners were those accounts that nobody touched. Think about that for a sec. The winners weren't the most active, the most educated, the most informed. The winners were the ones who weren't paying attention at all. So why would doing nothing beat people who are actively trying? How would a dead guy outinvest a Harvard MBA? That question should bother you, because the answer means that most of what feels like smart investing, the research, the timing, the reacting, is actually making you poorer. Here's the thing about investing that nobody tells you up front. In almost every other area of life, trying harder works. You practice more guitar, you get better at guitar. You study more, you do better on the test. Investing punishes that instinct, because every time you do something, check the price, read the news, make a trade, you feel productive. You feel like you're on top of it. But the market doesn't care that you feel productive. And usually, what you just did cost you money. How does it cost you money? There are basically 3 traps. Trap 1, you buy high and sell low. Wait a minute. People usually think, I don't do that. Buy low and sell high is like investing 101. Well, here's what that actually looks like. A stock has been going up for 3 months straight, every week higher. Finally, you buy it, because now it feels safe. It feels proven. 2 weeks later, it drops 20%. That's not bad luck. That's the trap working exactly as designed. But when you're buying before the drop, you feel like you're making a rational decision. It's not that you're stupid, it's just that you're human. You buy when you're excited, which is usually when prices are already up. You sell when you're scared, which is usually right before the recovery. Trap 2, you let the news run your portfolio. Every time there's a recession headline, millions of people sell. The market recovers, they buy back in higher than when they sold. The news was right. Something bad probably did happen, but the instinct was still wrong. The news is designed to make you feel like you need to act. The market is designed to punish that behavior. By the time you see the news, the market has already reacted. Prices move on new information. News you're reading is already old information in market terms. Profits come from being early, not from reacting late. Trap 3, the slow bleed. Every trade costs something. Fees, taxes, spread. Individually, they may seem small, but compounded over 30 years, they make the difference between retiring early and working until you're 70. Now picture someone who avoided every single one of those traps. No panic selling, no chasing hype, no unnecessary fees bleeding out over decades. You'd assume they had some kind of clever system, years of discipline, maybe a really good therapist. They didn't. They just weren't there to mess it up. Nobody home to make the mistake. And that's the dead investor advantage. The best move they ever made was accidentally doing nothing. Now, this isn't actually advice to do nothing. It's advice to stop doing the wrong things, which is just plain bread finance. That might mean turning off price notifications, deciding in advance that you won't react to headlines, and actually not reacting. The goal isn't inaction. The goal is removing the interference, the noise, the reactions that feel smart but aren't. Most investment advice tells you what to do. The actual, real advice should be knowing what to stop. Think about planting a tree. You put it in good soil, you water it, and then, mostly, you leave it alone. You don't dig it up every week to check the roots. You don't keep replanting it because another spot looks better. You plant it right, and then you let time do what time does. Your money works the same way. The compounding happens in the waiting, not in the managing. So the best investor in the world might genuinely be someone in a graveyard. Not just because they found a secret strategy or were brilliant in picking stocks, but because they were the only ones who got out of the way and let the thing work. In investing, effort does not equal results. Restraint does. The less you interfere, the more you keep. But here's the thing. Doing less only works if you set it up right in the first place. The dead investor had to plant something, and you need to know what that something is. If you want to understand what to actually put your money into, watch the All of Investing video right here.